Here we are looking at an upward trend. We can see that on the chart we have a swing high, a higher swing high, a higher swing high, a higher swing high, a higher swing high, and finally a higher swing high. So we can see the higher highs as the market's moving up, and we can see the higher lows as the market's moving up. The interesting part here is we need to look at the moving averages in a little bit more detail just to find out what's really going on there, and to look at the order, angle, and separation. Remember that the order of the moving averages gives us the direction that we want to trade. The two moving averages that we have on this chart right now are the 20 moving average and the 50 moving average. So that's a 20 moving average and the 50 moving average. That means if the 20 moving average, the blue line, is above the 50 moving average, the red line, we expect the direction, the order, the direction of the market is to the upside in an upward trend. So from this crossover here of the moving averages, when the 20 crosses through above, we go, okay, now in upward trend, we're looking for buy positions. And we can see that overall, that market moves up. And again, that's the order of the moving averages that's being used to give us the direction that we want to trade. We've also got the angle of the moving averages as well. And it's important that we look at what's happened from being sideways moving averages to them pointing up, crossing over to give us the direction as well, and we can see that the angle of the moving averages starts off sideways, points up for a considerable period of time, and then starts to turn down again. But ultimately, it's that angle that shows us that for the majority of this chart that we can see, we have a solid upward trend. And we're looking primarily there at the 20 moving average, because that's the first one that's going to move. But we can also see, looking at the 50 moving average, from being downwards to sideways to then pointing up, it points up from around this kind of an area here, where we get the crossover as well. And we can see that when the 20 crosses above the 50, both moving averages are pointing up, which indicates a solid, strong upward trend. And the final part to be aware of here is the separation of the moving averages. We see all the way along the 20 moving average is moving further away from the 50 moving average. This informs us and tells us the trend is likely to continue. And we can see that happens for quite some time. And as the moving averages then start to squeeze together, which we can see at the right hand side of this chart, the trend starts to end. The moving averages are closer together, and the separation obviously has stopped. The moving averages are now squeezing together, so we're thinking that the market could go sideways or down. And as soon as those moving averages cross over again, which we see here, the angle is good, the separation is good, the market continues to move to the downside. If we look at this in a downward trend as well, we've had sideways moving averages. The 20 then crosses beneath the 50, so the blue crosses beneath the red, which gives us the order for a downward trend. This downward trend continues, and we're happy that it's a downward trend because the angle of the moving averages are pointing down. And the final part to this, of course, is that the moving averages are separating all the way along. We can see there was perhaps one moment here where they squeezed together momentarily, but on the whole they are separating the whole way down through that chart. And again, it's that 20 moving average moving further away from the 50, which tells us that the trend is still moving down. At the end of the trend, we see the moving averages now squeezed together. We're no longer interested in the downward trend. And if we carry that on now, we can see the trend now changes from being a downward trend. Now they've crossed over. The angle of the moving averages is good. the separation of the moving averages is good, and the trend starts to move to the upside. So there we go. We can see in the downward trend the order of the shorter term moving average underneath the longer term moving average gives us the downward trend, and in the upward trend the shorter term moving average above. That's what gives us the direction. The angle, of course, if they're pointing down, market's moving down. If the moving averages are pointing up, market's moving up. And it's that separation between the moving averages that convinces us the trend is likely to continue. And of course, at the end of trend, we see that squeezing motion where the trend starts to end and tells us, do you know what? Time not to be here anymore. Wait and see what happens next. And sure enough, it then turns into uptrend, which we can trade, of course. Then the moving averages start squeezing together, telling us the trend is over. And then they help us out again with the continued downward trend. So there we go. Moving averages are incredibly useful for helping us in upward and downward trends. Going back a bit further, of course, we can see the upward trend before that. The order of the moving averages is good. The angle of the moving averages is good. And the separation of the moving averages tells us that all the way through there we had an upward trend. Moving averages are also very useful for telling us when not to trade, as we can see on the left-hand side of this chart. When the moving averages go sideways through the price action, that tells us that the market is moving very sideways and very range-bound. This is a very difficult market to trade profitably. As a result, it's safer just to stay out the way and wait for that trend to start.